What is up, future Philippine CPAs? Let's dive straight into this explainer. We specifically designed this to actively hardwire the core FAR accounting equation into your brain for the next 3 years. We absolutely know your ultimate goal is crushing the LCPA, so we're building a rock-solid, distraction-free cognitive foundation today that's going to stick with you all the way to your final year of undergrad. Let's get into it.
So here's our game plan today. We'll hit the core equation, expand the equity engine, cover the dual effect principle, analyze transactions, share some retention hacks, and wrap with a rapid review. Giving your brain this mental map right up front actually drastically improves your comprehension and recall.
All right, Section 1, the core FAR accounting equation. Let's plant this foundational mental model on a totally clean canvas.
Take a look at the pure visual simplicity of this framework. Assets equal liabilities plus stockholders' equity. I mean, this is the absolute bedrock of accounting right here. If you want to survive FAR, this equation literally must become second nature to you. So let's lock these definitions into your long-term memory right now. Assets provide future economic benefits. It's essentially what you own. Liabilities are existing debts, what you owe. And remember, creditors always get paid first. And stockholders' equity, well, that's your ownership claim. It's the ultimate residual. It's whatever is left over after all those liabilities are completely settled.
Moving on to Section 2, expanding the equity engine. Let's see how this basic model actually builds into a dynamic engine.
This side-by-side contrast is literally designed to map the differences straight into your brain, showing exactly how retained earnings drives the changes in overall equity. On the left side, you've got the basic static view. But on the right, that's where you can see how revenues, expenses, and dividends actively dictate the dynamic pulse of a company's net worth.
Notice the mechanics here. Common stock and revenues pull the equity side upward, fueling that business growth. But expenses and dividends actively drain it. You can see those negative signs. When you're analyzing transactions on your board exams, you need to be able to close your eyes and vividly visualize this exact tree structure.
Okay, listen up, because here is a massive warning for your board exams. Dividends are not an expense. Let me repeat that because it's a classic trap they will try to catch you on. Dividends are not an expense. They are a direct distribution of your retained earnings back to the owners. They do not get factored into your net income. Put a mental pin in that one.
Section 3, the dual effect principle. Let's dive into an absolute, non-negotiable law of FAR that you just have to internalize. Before you even touch a ledger, you have to identify if an event actually matters, right? Always ask yourself, did the financial position, meaning the assets, liabilities, or equity, actually change? Like discussing a product design with a customer? Nothing changes financially. But paying rent? Oh yeah, that hits the books for sure. And when you do record it, remember this golden rule. If an asset increases, there must be a corresponding decrease in another asset, or a proportional increase in a liability or equity account. The scales of the equation can never, ever tip to one side. It's all about perfect balance.
All right, Section 4, analyzing business transactions. Let's take these rules from theory to action with some real business events, just like you'll see on the exam. Here's a super classic setup. SoftBite Inc. purchases equipment for $7,000 cash. What changes here? Pause and think about the dual effect before I reveal it. If we pay cash for equipment, how does our asset category shift? Nailed it! Cash decreases and equipment increases simultaneously. It maintains perfect balance with absolutely zero change to liabilities or equity. We essentially just swapped one asset for another. Easy, right? Now, zooming out, this tabular summary is your macro view. It beautifully organizes the data so you can visually see how every single transaction keeps the equation perfectly balanced down to the final totals. It's essentially the mathematical proof that the law works. Look at that bottom line. Total assets of $18,050 perfectly match the liabilities plus equity. Flawless balance every time. Section 5, LECPA Retention Study Hacks. To make sure this actually sticks for your board exams in a few years, let's look at some cognitive action plans.
Here is your first major hack. Never skip the step of mentally verifying that your equation balances after every single entry. I'm serious, it is the ultimate error-checking system for transaction analysis. Don't wait until the very end of a multi-part problem to check your balance. Check it row by row.
To make this next one stick, simply associate revenues with business growth and value creation, and associate expenses with resource consumption.
Making their positive and negative impacts on retained earnings instantly intuitive to your brain will save you so much precious mental energy during those grueling long exams.
Section 6, our 20-item rapid review. It's time for the ultimate cognitive retention hack, a rapid-fire active recall review of high-yield facts.
Scan these first 10 core concepts. Seriously, don't just passively read them. Mentally define their function in the equation before moving on. Make sure you can instantly differentiate an external transaction like, say, buying from a supplier, from an internal one, like consuming supplies you already have in the back room.
And boom, here are the final 10 crucial LECPA bullet points covering the fundamental assumptions, principles, and rules to really seal this knowledge into your long-term memory. Like, recognize that the economic entity assumption is the exact reason why the owner's personal coffee expenses never ever touch the company's books.
I'm going to leave you with this provocative thought to ponder. Mastering this exact type of analytical logic is what's going to make you a brilliant future CPA. If assets drop and liabilities didn't budge at all, the dual effect demands that equity must have decreased. But why? Was it an expense, a massive dividend payout? Think about it. Keep practicing, keep analyzing, and I will catch you on the next explainer.